Well, good evening, ladies and gentlemen. Terrific turnout on this cold night. I want to welcome you to our special event, and I want to thank Mike Friedman and our Emerging Leaders Group for organizing this event. The Emerging Leaders are the young generation of corporate leaders in Houston, individuals in various sectors who are going to be the future of our support in the next generation. And we've been very successful in growing our younger membership groups, the Associate Roundtable and the Emerging Leaders, which have actually quadrupled their membership from around 50 members last year to over 200 active individuals today. It is helpful to have some of these emerging leaders being former special operations officers, military intelligence, and Green Berets. They know how to recruit people. I have a proposition you can't refuse. So I want to thank Jim Crane, who is our relatively new Baker Institute Fellow, working with Ken Medlock in our Center for Energy Studies. He is our Baker Institute Fellow on the geopolitics of energy, and he will be moderating the discussion with our distinguished guests. So the emerging leaders asked me if we could recruit to speak tonight a top energy CEO. And, you know, I'm a totally objective person, and as chairman of Occidental, I thought the best CEO would be Steve Chazen, the CEO of Occidental Petroleum, and we're really grateful to you, Steve, for taking time out to be with us. So I'd like to turn to Mike Friedman now, who will introduce our guest speaker. Again, he is with the Emerging Leaders Committee. Mike.
Thank you, Ambassador, and thank you all for coming this evening on this cold night. As the chair of Rice University's Baker Institute for Public Policy's Roundtable Emerging Leaders Group, sort of elegantly long phrase for a young professional group, I hope that you guys enjoy tonight's program with our special guest, Stephen Chazen. The Baker Institute really is a unique place in Houston, with both many member and open to the public events, respectively, every week. Joining the Roundtable Emerging Leaders has never been easier, where this past year membership grew 419%, making it one of the largest young professional groups in Houston. I am told by no less than the Baker Institute's fellows, experts in their policy field, that all the cool kids in Houston are joining. This is according to their research and fact-checking and whatnot, and they're experts. Perhaps I should introduce our speaker, though, because this is probably the first and last time I'm ever asked to give an introduction here. After a short speech, Stephen Chazen will be joined on stage for a brief discussion with the Baker Institute's Jim Crane, the Wallace S. Wilson Fellow in Energy Studies, who will then afterwards open it up to questions, any questions that you guys have. Stephen Chazen is President and Chief Executive Officer of Occidental Petroleum Corporation, an international oil and gas exploration and production company and one of the largest U.S. oil and gas companies based on equity market capitalization. Mr. Chazen began his career at Occidental in 1994 as Executive Vice President, Corporate Development. He was named CFO in 1990 and served as CFO until 2010. Mr. Chazen was appointed President of Occidental in 2007. He was then named COO in 2010 before appointed Chief CEO in May of 2011. Mr. Chazen was elected to the Board of Directors in 2010. I just realized that you guys have this exact bio in your program. So I'm probably going to just cut to the good part here. Mr. Chazen holds several degrees. He also is an investment banker and a geologist. His degrees are from Rutgers. He has a finance degree from U of H, and he has a PhD from Michigan State in geology. Mr. Chazen, last but not least, was also a Vietnam War veteran, serving in that war with great distinction in the 25th Infantry Division, I believe. And he has since spearheaded as CEO many military veterans initiatives, making Occidental Petroleum one of the nation's leading veteran companies. Ladies and gentlemen, if you would please help me welcome Stephen Chazen.
Well, welcome everyone to the Baker Institute tonight, and especially welcome Stephen Chazen. We're delighted to have you with us tonight. Would you like to say, start out with a few words just about your background?
Well, since it's sort of a management sort of thing, I thought I'd tell you a little about my background. The other background misses 4 or 5 jobs that I held for short periods of time. I had a hard time holding a job, which you'll soon discover. So when I finished college, it was during the Vietnam War. I was drafted. So I have it was a U.S. was the first initial of my number, which was unwilling servant, and I went to Vietnam, and I was a dog handler.
Really?
Really.
Wow.
And the dogs found mines and booby traps. The dog was a good dog, as you can see by my continued presence.
Wow.
And I would take apart the mines and booby traps and send the pieces back to wherever they came from. And it's a useful life experience. Every day I'm glad I'm alive.
But useful in the corporate world, I would imagine.
Well, the corporate world was more about snakes, I think, than mines and booby traps. So I went back to graduate school because I didn't want to go to work. So I taught kids. I taught geology. I minored in statistics, which was odd for geologists. And I've always been sort of numerically oriented in geologists. I was a quantitative person in a qualitative field. And when I got out, it was a downturn in the oil industry. And so I couldn't find a job, so I got a job at Johnson Space Center. So the lab with the rocks, that's where I worked for 4 years. Went to business school at night, and then took a job for a gas company when the business turned. After that, I was fooling around one day, and somebody said, "Did you want to be an investment banker?" And of course, somebody had explained to me what that was. And so again, I was fairly lucky because I got good demographics because of when I was born, and there were not many people ahead of me. So I went to work with Merrill, and became head of the energy group, and then head of corporate finance at Merrill. So one day I come home, and my wife says to me, "Why are we doing this?" And of course, I had no explanation that I could come up with. And so phone rings the next day, and somebody at Oxy, which was a client of mine, said, "We got this job." I said to my wife, "You want to live in California?" And she said, "No." So I said, "Don't worry. They'll go broke in 3 years, and we'll be able to move back to Houston."
Took a little.
So she holds this against me because she thinks I knew. So we were there 20 years in California. So it's had a pretty varied career, a lot of different people. I think the underlying thing was, it's always been I've always been around volatile businesses. Aerospace business, I always thought I was going to be fired the next day because that's the way it worked. And so I always thought got used to volatility. Oil business has been volatile. It's volatile now. It was volatile 20 years ago. So it's been an interesting now 40 years.
Your anecdote on California is a telling one, because you just moved the company. You and the board decided to move the company from California to Houston just recently. So I guess you made good on that promise eventually, and you brought
you don't get a lot of points for a 20-year error.
So, but I wonder if you could talk a bit about your decision there. So you've got assets in Texas. You've got a lot of assets in California. You're the #1 producer of oil in the great state of Texas, from what I understand. But you have a significant holdings in California. But you've decided recently to.
Well, we built the California business. I mean, the reason that Arm & Hammer put the company in California was that the William Morris Agency was located in the same office building as Oxy, and he had an interest in whatever they produce.
Okay.
You need to know what the William Morris Agency is.
Okay.
It's a talent agency.
Uh-huh.
So that was the attraction to California, I think. We had one property in California, which we still have, and we built the business in California over the last 15 or so years. First buying Elk Hills from the government, U.S. government, and adding on. It's gotten to the point where it's a stable business. So I'm not particularly good at dealing with California politicians. I have a reasonable relationship with them, but Governor Brown would want me to do something, and I'd say, look, if you don't want, we want to do something stupid like that, we'll just put the money in Texas, which was not a particularly effective negotiating technique.
So here you are.
So here we are. The real reason for the move is it's practically impossible to recruit oil people into California. They just won't work there. It's not about the money per se, but let's say you have some guy who's an engineer somewhere and sends his kid to school. He can't send the kids to public school, so send your kid to private school. And the kid comes out and he says to his father, well, my teacher said you're a polluter. Well, this discourages people from bringing their families there. So generally speaking, it was not a particularly good place to locate an oil company. I will say that years ago there were many oil companies in Los Angeles, and I think Brightburn's the last one left. It was filled with them. And if you drive from Los Angeles Airport up north, you pass by oil field after oil field after oil field. Still a very large oil producing state. So, it's got the physical ability to produce oil, just have a mental problem.
I suppose Chevron will be next.
I don't think so. I spoke for the first time to the mayor of Los Angeles, the first mayor I'd ever spoken with. He called a month after we decided to move. And he said, well, how do you get companies to come to Los Angeles? And I said, well, there's no sense in talking to the CEO. You need to talk to the CEO's wife, which makes all these decisions. So I think the California is a very difficult place to attract people generally. It's not so much the cost, although it's certainly costly. The joke I tell at the Houston Petroleum Club, but not in Los Angeles, is I always viewed Houston and Los Angeles as the exact opposite of each other. Houston has bad weather and good people, and Los Angeles has good weather.
Fair enough. Okay.
Doesn't travel well outside of Houston.
Right, I imagine.
I used that at a petroleum club once, and some guy got up and said the weather in Houston was great. So.
I moved here from England. I like the weather, but okay, that's a different thing. I suppose it's all relative. So you've taken the helm of Occidental at a really important time here. There's a big shift underway in the oil sector. So demand's been moving beyond the developed world into some of the fast-growing emerging economies in the developing world. And at the same time, here in the U.S., production is undergoing this renaissance, happening all around us here, in fact. And so these tight markets that we grew accustomed to over the past decade have started to slacken a bit, partially due to some of this growth in production here in the U.S. So I wonder if you could just talk for a little while just about some of these new market dynamics and how you see these shifting currents affecting the oil business around.
The oil business has always been a cyclical, volatile business. Price of oil is not particularly predictable. I met with somebody over in the Middle East recently, and runs a national oil company over there, and they buy all this research. They buy research from Goldman Sachs and all these people. And so he said, well, 4 months ago, they had this research and it said this stuff, and now they have this other research that says 180 degrees out. He just didn't understand how that works. And so I asked him how much he paid for the research. And he didn't know, but he guessed $10,000 or something like that. And I said, how much do you think would be worth if you could actually predict oil prices more or less than $10,000. He said, really, I never thought of it that way. He just called and canceled all the subscriptions. If somebody's giving away this information, it's probably not very useful. There's always been, in my experience, a growth area in the world where production is growing and overcoming the natural decline in the world. Outside the world declines 5, 6, 7% a year in production. That production has to be replaced every year. Somebody has to be growing their production. And it shifts from country to country, from place to place over the last decades. Right now it's in the United States. Oil generally is demand driven rather than supply driven. When the world economy's not so good, oil prices are low. When the world economy is pretty good, oil prices are higher. The old joke was that the solution for high oil prices is high oil prices, and the solution for low oil prices is low oil prices. So you should, if you're running a company, an oil company or any kind of business, you should be prepared for this kind of volatility. It shouldn't come as any great, maybe the timing's a little surprising, but you shouldn't be surprised about it, and you need to be prepared. I always tell people there's a whole bunch of risks you can take in the oil business, but you can't take every risk. You can't just say, well, I'm going to be a high-risk explorer, and I'm going to have a lot of debt on my balance sheet, and I'm going to let the commodity prices roll. You can't take all those risks. The probability of success gets smaller. So, we have a different risk profile. We don't take a lot of geologic risk. But we do take full commodity risk. Other people hedge their commodities. But it's just a different way of looking at how much risk are you willing to take. Some people apparently enjoy failure, so they take lots of risk. I could name some names, but we won't do that.
What about political risk? I mean, you're selling or you're divesting a bit from some of your assets in the Middle East. I mean, Oxy's got what I would say you've got sort of two classes of country that you work in. You've got, on the one hand, you've got Iraq, Libya, and Yemen, which so two of those countries just had their leaders overthrown. One of which was lynched. The other one is in civil war, more or less.
No, we were there when Yemen killed the guy, so.
Okay, all right. So you're no stranger to upheaval and risk. But then on the other hand, you've got assets in Abu Dhabi, in Qatar, and in Oman, which are much more stable entities. But maybe you could talk a little bit about your overall strategy in the Middle East, and maybe why you're selling some of that off, and about how political risk might affect your share price, and whether you think the analysts have got that right.
Only about 5% of the assets are in the Yemen, Iraq, and Libya crowd. Historically, despite the very difficult government in Yemen, we did very well in Yemen over very long periods of time. You generally find that no matter what the country wants the money. That's at least been the historic experience. I think the best one I can remember is Gulf Oil, which was eventually bought by Chevron. It had a big concession. I think Chevron still has it in Angola. Went through this enormous revolution. All these so-called communists took over. Not a brick was removed from the wall around the concession because the new revolutionaries wanted the money. And I think historically that's the way the industry's run, that the economic interests of the country overcame whatever political differences there were. It is possible this time is different, that the people's objectives this time are not purely economic, but have some other ones, although in the end, they all want the money. So the noise and the politics, you manage typically by seeing how quickly you get your money back. If you go to a place, if you want to go to Venezuela, for example, you would have to have a contract where you got your money. You never really had any net investment in it. And that's the way you have to approach some of the riskier places. A place like Abu Dhabi, you know, I feel better about investing in Abu Dhabi than I do in, say, California.
Interesting.
It's got a more rational government. The sell down is, you know, we have right now we're 55% the United States net after California, and 45% Middle East. We have some in Colombia. Generally, people think that's a little too much in the Middle East. We have more in the Middle East as a proportion than any company in the world, more than, say, Total or something like that. So people think that's too much. Americans view all these countries as the same. And, you know, it's unfortunate, but I can't fix that. So we're trying to reduce our exposure some, taking some money out and taking that money basically and putting it in the United States. Some response to what shareholders want. We've historically done very well in the Middle East. It's been very good for us. We would just hope to reduce it a little bit and then begin growing it again. There's lots of opportunities there over time. It's a tough environment now. When the oil companies went into Iraq, they overpaid for the leases. And some of that view that oil companies are run by morons has permeated the environment over there, and people, you know, the countries think that an oil company will do anything for anything, any amount of money, and so I think the industry's, I think, sort of figured that out. A typical contract in the Middle East, around 20% of the profits go to the oil company, and about 80% more or less go to the country. In the United States, if you count royalties, it's, you know, 60-65% of profits go to the oil company, and the rest go to either the tax regime or the royalties. So if you think about it that way, the United States and you get to hold it forever. So you have to overcome this economic issue with, you know, better wells, essentially. So I think that to some extent the Middle East is changing, and it's much more difficult now to deal with than it was a few years ago, basically because the oil industry showed it wasn't disciplined financially, and they showed, well, these guys are fools. So I think, you know, we're headed to an environment there. They're looking much more to not the United States, but to other countries, China, Korea, those sorts of things. But they still want American oil companies there, because we have a Foreign Corrupt Practices Act and other countries don't. And so they still want American companies, and most American companies, except for us to some extent, don't really want to go into the Middle East now. It's less popular. So, you know, I think I think it's changing a little bit. It'll change back over time. The countries are, you know, the small countries you refer to are quite prosperous. In Oman, you run it really very differently. Virtually all of our employees are Omanis. We don't have hardly, you know, we have a handful of expats. The government just stole the head of our operation, made him head of the national oil company. So,
wow.
So, you know, it's in Oman is a very different, it's more typical of the developing world, where you need to have virtually all your employees to be locals, provide a lot of training, education, that sort of thing. Our offices here in Houston are filled with Omanis and Colombians who come here to learn for a couple of years, and they go back to their country. That's something you have to do when you run an oil company. In Qatar, that's not practical. There's only 200,000 citizens, right. And there's Abu Dhabi, the same amount, and except in Abu Dhabi, except for women in Abu Dhabi, there's almost impossible to hire a male.
Wow. Just staying in the Middle East for one more question. You do spend a lot of time over there, and you're running in circles among folks who may have some thoughts about OPEX strategy and oil prices and production, et cetera. I wonder if you might just ruminate on that just for a moment.
I think what you hear is not what you hear in the New York Times. What you hear more about is the weak demand in China, and much less about these geopolitical stories you read about in the New York Times. There may be some ancillary benefits to a low oil price. Nobody's in love with Iran. Certainly nobody's in love with Venezuela. Certainly nobody in love with Russia. And those may be ancillary benefits, but I think their main focus is pretty rational. Their main customer is having a rough patch, which is China, and a little lower oil price to help China out is probably not a terrible strategy for a while. I don't know what they'll do about any decision in OPEC. Generally, the three countries that decide everything as far as production, Kuwait, Abu Dhabi, and Saudi Arabia, I suspect they do that not in the meeting. But I think if you look at it from a purely economic, rational perspective, they want to make sure that the demand is good, and the way you do it is you cut the price, give your customer an opportunity to recover.
So let's see China come back a little bit before
they
start cutting
I think that's what I would guess. It's not about U.S. shale production. It's not about, I don't think, it's not about all this other stuff people talk about. I think it's principally a very rational view of their market.
Interesting.
There's not really a glut. I mean, a glut looks like boats riding around loaded with oil. We just don't have that now. So I don't think there's a glut. Maybe a little oversupply occasionally, but we don't really have an oil glut.
Yeah, just not the demand you were expecting from China.
China is the driver of demand that isn't the United States.
Well, let's shift gears a little bit, and we've got the Emerging Leaders Group here with us tonight, and we've got some budding corporate leaders who one day would probably like to be in a position like yours.
I wouldn't recommend it, but
I'm sure they'd love to hear about your management style and some of your take on running a big company like Oxy, and how you manage to get not only the best people, but get the best out of your people.
Well, we have 14,000 employees and typically 60 to 70,000 contractors. Probability of having everybody in the top 2% of ability out of that group seems unlikely. So you got to assume that it's going to be somewhere around average. What we ask of people is really just three things. We ask that they have sort of average intelligence. They don't have to be smarter. Don't have to, we can even take some little dumber ones. It's okay. We find that hard work, overcomes almost everything. So and I can't change people's work philosophy. We got people who don't want to work. They could be real smart. The smartest guy I ever met works at Lawrence Livermore Labs, figuring out when the Russians or somebody are setting off nuclear bombs. I mean, I don't think he's worked more than 2 hours a day in his whole life. And so he wouldn't work well for us,
okay,
even though he's a really smart guy. And then finally, we ask for integrity. I can't teach people integrity. Integrity is a strong word. It isn't just being honest. You need to have people take responsibility for the good and bad things they do. Everybody makes mistakes. And so you have to own up to your mistakes and not try to pawn it off on others. I think integrity is the most important thing that we look for in an employee. I can't teach those things. You sort of come with that or you don't. if you don't, we wish you well and hope you go mess up some other company. And I give them names, the companies.
All right.
So, those are the things that we look for. We allow them to make mistakes. A fellow I know it's a family business, and he runs a mutual fund. His family name is on the door. And it's his grandfather's business, and his father ran it, and he's running it, and he's training his son, hopefully, to run it. And so he decides the plan is to give his kid $100,000 to invest, and the kid could do anything he wants with the money. And the plan was the kid would lose it all, and he would discover this is not so easy and everything like that. So he takes $100,000 and buys Google stock at the offering. And now he thinks his father has got the easiest job in the world. And I think the same thing is true about the oil business. I think the mistakes are the most important thing. The management has to say, okay, what did you do? And what are you going to try to do not to repeat the same kind of mistake? You're going to make more mistakes. And I think that's the best thing we can do. There was a famous person here in town who's now gone, and company, his name was on the door of the company too. And he was trained as a geologist. And he used to walk around the office with a big eraser and a pencil in his pocket. And he'd go into the geologist's office and he'd look at the map. He'd yell at the geologist, "You moron, the fault's not here," and he'd erase the thing. This was before they had computers. And he'd move the fault line. And then when the well was dry, he'd blame the geologist. So, that's probably not the kind of management technique you want. You need them to make the mistakes. They'll make the mistakes. They'll learn from them. And you just need to foster the management, the supervisors, to do that. The other thing I think for the oil industry especially is that the world is changing. It's a much more diverse workforce in the oil industry than maybe existed 20 or 30 years ago. My wife is a geologist, and so she was interviewed, and I won't say the name of the companies, they don't exist anymore, but she was interviewed, and she was told, this is 40 years ago, that they don't hire women geologists. Eventually she was hired by Getty Oil, which also doesn't exist anymore. And so you can't do that anymore. Our offices in Houston are filled with people from all over the world. And as we train people to come into our business, it's real important for people to understand this is a diverse culture, diverse business. It's not, everybody isn't going to go work for Clayton Williams. And so I think you got to understand that. The nature of the demographics of our business, our average age used to be 51 a few years ago, now it's 45. I don't have any 45-year-old employees. I've got 30-year-old employees and I got 60s, but I don't have any 45s. And everybody in this business looks like that. And so you got younger people with very different views about work. It's not about whether it's right or wrong, it's just a different view about work. Now when they come in to interview, they ask about vacation and holidays. I was trained when you interview, never ask about that. And as a result, I haven't taken any. When I had my 40th wedding anniversary, one of our directors asked my wife what I was doing, and she said, in honor, Steve has taken 40 hours off. And she said, wow, a whole week? She says, no, Sunday and part of Monday.
Wow. All right. Well, one more question before we jump to the Q&A here.
Sure.
I know we've got a lot of veterans in the audience tonight, and including some folks who've spent some time in Iraq and Afghanistan. You, sir, are also not just a veteran CEO, but a U.S. military veteran, as you mentioned. In fact, a Vietnam combat veteran. So we'd love to hear how, we'd love to hear how those experiences might have shaped you personally, and if they've had any influence on how you operate as a CEO.
You never really know what all the factors are that shape you. I think if I thought about it, the dog and me were first in the patrol, so as a result, I've learned to trust myself more than other people, which is not necessarily a good thing, but that was what you came out of that. The second, the military provides you with a lot of different people in a lot of different backgrounds, people that some guy who wanted to teach college, at least he thought he did, until he found out he didn't like faculty members, was going to do, and all of a sudden you're in Ranger School or airborne school, and you're afraid of heights, and you got to jump out of a plane. So it molds you that way because you make a lot more understanding of different people and different people's views. We like hiring military in Oxy. The military people are goal-oriented. They understand they have to do a job. They tend to have a good work ethic. We got a lot of jobs. The oil industry is the last major industry in the United States where you can come out as a high school graduate and go to work for us or Exxon or Shell or somebody and get the middle class lifestyle, send your kids to college, get good benefits, all those things that Ford Motor and General Motors used to do for people. And this is the last industry like this. So it drives me nuts when I hear people talk about how bad the industry is. This is an industry led by graduates of public universities. This isn't an industry run by people who graduated from Yale. And it's a very different industry. I've known the people who run these companies in my whole working life. It's a terrific business to be in. It's a great business for bringing people up, giving people an opportunity, and even field jobs are great jobs. It just drives you nuts when you hear people talk about this. I'm chairman of the American Petroleum Institute. We put an ad program out to talk about not just the jobs, but actually the quality of the jobs people have in this industry. It's just an incredible opportunity for people. I will say, when I was an undergraduate, I was riding in a car with the chairman of the geology department at Princeton and a couple of famous geologists who turned out to be famous. And I said I wanted to work in the oil business. And he looked at me and said, "You won't like it because it's all run by engineers." So I minored in math. And so the second thing you won't like is you won't have a full career because we're going to run out of oil.
Wow.
So that was a little over, now almost 50 years. So, it's been a great career for people. It will be a great career for people. It's an incredible opportunity to go to work for an oil company. Really a privilege to be in this industry.
Great, fantastic. All right, so why don't we move to Q&A? If anybody's got any questions, please just line up at one of these two mics. There's two mics, one in each aisle, and then we'll just alternate from one to the other. And feel free just to line up if if there's somebody there. You don't have to wait for them to sit back down. Sir.
Thank you. Thanks for chatting. Two quick questions. Do you have any impressions as a former banker on the Baker Hughes Halliburton deal and any sort of deeper implications that might have trend-wise in the industry? And then secondly, do you think oil companies should follow what you guys did in picking up the Fibro unit at Citi and move more into commodity trading because banks, just aren't able to do it anymore? Thanks.
On the first question, Ed warned me before I got up here not to say anything that would get me in trouble, so I'll pass on the Baker Hughes thing, except to say, for the U.S. business, they're direct competitors, and competition lowers prices, and reduced competition generally raises prices. Outside the United States, the dominant factor is Schlumberger. And Schlumberger could use some competition. So I think outside the United States it's probably pretty good for the industry, and inside the United States, I think it remains to be seen. On the trading business, we trade. Our base business trades more commodities than Fibro does. We produce 700-some thousand barrels a day. I got to hedge all that every day. So we've always had a big trading business. I think all the major oil companies have huge trading businesses. One of the issues that's happened is that the government's kept the banks out, so there's less liquidity than there was before. With less liquidity, there's more volatility in the price, and I think that's probably what you're seeing now. There's just not as much liquidity. That's true, by the way, in the equity markets, too.
Sir.
Thanks for being here. Obviously, with the shale revolution going on, the strategic interest of the U.S., and particularly places like the Middle East, seems to be changing. Are you hearing any good substantive debate and conversations about what the role of the U.S. needs to be playing in that region, given that we're no longer really the primary beneficiary of the oil that's exported out of there? It's really Asia, as you mentioned, China, et cetera. And obviously these things can't change quickly, but are you hearing any good, intelligent debate about if we had to start over with our foreign policy in the Middle East today, what would it be?
Well, I certainly wouldn't get that out of the current executive branch. That fall into things I wasn't supposed to say. Maybe I can better answer it from the point of view of somebody over there. The credibility of the United States has not been enhanced the last half a dozen years in the Middle East, and they are looking to other people. Whether we should have a different defense policy. Let's say, you say, well, we don't get the oil from the Middle East. That's probably true. But let's say there was a disruption. The price would probably change. So we have an economic interest in the world. And we have an interest that the world economy runs reasonably well and is not disrupted. It's not an argument one way or another for any kind of military action or anything. But I do think that the United States is hopefully the only, an adult in the room. And I think its role in the Middle East is to make sure that the commerce goes normally. If commerce goes abnormally, we suffer too. If with China into recession, let's say, because of a rise in oil price or something, that's not particularly good for the United States, because our businesses depend on the world, not just we're not an island. So but I don't. In the Middle East, I would say that they're generally not. Their enthusiasm for the United States, I think, as a power have declined in the last 6 years.
I imagine they're still enthusiastic for our security umbrella, though.
Well, a country like Abu Dhabi, what has he got? 6 airplanes, and they don't want to go under a Saudi umbrella.
Fair enough.
I think that I'm not an isolationist at heart.
Right.
So I just think that the United States is the only real world power. We have to make sure that the world functions normally, because it's good for us in the long run, whether it's in the Middle East or somewhere else.
And one of the things I used to hear in the Middle East is that when the sheikhs dial 911, it doesn't ring in, Beijing or Moscow or Paris or whatever, wherever the point the person was trying to make. So I think we're still on the hook for that. Sir, please.
Thanks for the great talk, by the way. My question is about Iran's geopolitical situation happening. And I wanted to ask that the fate of the country oil's market is kind of dependent on the November 24th talk that is coming in a week from now. That I wanted to ask that if you could share your thoughts perhaps of the Iran's impact on the global oil market if it enters the oil market, and if not, what consequences, or if even the market itself has considered that Iran will join, given the oil prices that have dropped quite significantly recently. I appreciate if you can share some thoughts with us.
Yeah, I don't think about Iran, but I will say that a lot of the oil is making its way to the world market. I don't think there's much shut in. So it's making its way one way or another into the world market. So I don't think the sanctions are working to keep it out. Sanctions are working maybe to keep them from development, that sort of thing, but I don't think the sanctions are working to keep their oil out, and probably quite small effect. More effect probably would come from if Libya would stabilize, which doesn't seem real likely, or perhaps if Iraq were a little more stable, has probably a greater effect. I think the Iranian oil is getting out, just maybe not the most efficient way. I'm sure there's extra profits being made by somebody in the transportation there. But I don't think the sanctions are doing all that much, except by keeping them from developing more.
Ma'am, please.
Hi, Mr. Chazen. My name is Mariana Diaz. I am a member of the Roundtable Emerging Leaders here, so thanks for being here. I also work in public relations and wanted to ask you, because we know that oil companies and energy companies don't always get the best press, if you could communicate a message about Oxy specifically that would be on the front page of the Wall Street Journal tomorrow or another big paper, what would it be?
Well, actually, every day I open the Wall Street Journal up and look at the index. I look under O, and if it's not there, it's a good day. And I was sitting at a meeting, and Rex Tillerson was across from me. He was opening up the newspaper, looking for E, and he says, "A good day." We're never going to be popular. It's never going to be, people with, some guy at Google can do anything, but for an oil company, we're just never going to be popular. When you need something, when it's a necessity, you're just never going to be popular. If I could do something, I would ban the Dallas TV show forever. Probably did more harm than good for our industry than anything else ever done.
I used to be a journalist in a former career, and just to follow on this, sometimes to get people to call me back because they knew I would have bad news for them, I would have to say, sir, leave them a message, say, give me a ring back. I've got great news for you. And of course I didn't. That was just a way to get them to call me back.
You're like most of the journalists I've talked to.
Thank you. Sir, please. Yes, Ian.
Here, the reduction in the price of oil has a positive effect on the retail industry, airlines, transportation, so forth. How does the oil industry propose to cope with a lower price for oil, but at the same time maintain reasonable profitability?
The way it's always done it, I assume. I can't speak for everybody in the business. You focus more. Instead of drilling wells that are far apart, you focus on your best prospects. You put pressure on your suppliers, service industry. Service industry is very profitable. It's going to be less profitable in the future. You You try to figure out ways to get more out of the ground. And you probably, so what happens is your marginal opportunities, basically you don't fund them. And that generates better profits. It makes less production, you should understand, but it makes for better profits. So when I look at my capital program, and I got stuff up here that makes a 40% return and 30, 20, 15, 10, 5% or 10, say 10%. So I have this range, and when I take my capital program, I just go down the program and say, okay, I'll stop right here. This is all the money I have. And that's at 14%, let's say. So if you change the oil price, that little list changes. And some of the things that were at the bottom, you just don't do. And that's historically how it's been done. There'll be some cost savings from this out of the service industry, but principally what happens is you cut off your lower return projects. And then, we have maybe 5 times as many projects as we could fund right now, and so we'll have 8 times as many.
Oh, Mike.
Hello. Yeah, I'd like to follow up on the 2 last questions and sort of combine them. My name is Arne Grawi. I'm a professor of reservoir physics at the University of Bergen in Norway. I simply had to fly over for this event.
Is it dark there now?
It's for sure cold. My interest would be related to the fact that Oxy is very active in applying CO2 for EOR. Mm-hmm. In Europe and also in the US right now, there has been a increasing interest in looking into how oil and gas recovery can be more sustainable. And I'm also chairman of the Nortex Petroleum Cluster, and one of the things we have been focusing on, and I'd like to, if you would like to share your views on the fact that the background quickly in 2 sentences, there's a white paper in 2010 stating there is 137 billion barrels of oil that can be recovered in the US by next generation CO2 injection. 68 billion barrels is actually economic under $85 a barrel for the oil and $40 a ton for the CO2. The challenge, though, is that there is only 2 billion metric tons of CO2 in the US, and you need 20 billion metric tons to realize this potential, which would reduce the import of foreign oil to the US by 30% and produce approximately 1.5 billion barrels of oil, additional oil, for 50 years in the US. What I find very interesting, I would like to see, to hear your view on that, is since we lack the CO2, what would the potential economically and technologically be, you think, by applying anthropogenic CO2 captured from the power industry in the US, where they shut down the coal-fired power plants and ship the coal to Europe for us to burn it. What about burning coal here, capture the CO2, re-inject it? It's a win-win situation. You store the CO2 and you produce more oil and gas.
Oxy is the largest CO2 maybe in the world. We have our West Texas operations, are, the majority of them are CO2 injection. The CO2 there comes from a CO2 reservoir, not from power plants. The economic issue is that when the CO2 comes out of the power plant, first of all, you need a lot of CO2, but when it comes out of the power plant, it needs to be purified. Because if you put, it's got impurities in it, it corrodes the lines and stuff, and so you can't really use it that way. It has to be purified. It probably runs you, because we looked at some detail, exactly what you're saying. It's a coal-fired plant, and the cost of taking the CO2 and stuff was in the 350 an MCF. basis. So that's, you in a high quality reservoir, you multiply that by 7. So that gives you 21 times 7, it gives you about $30 of takes 7 MCFs of CO2 to make produce a barrel of oil. In bad reservoirs, it's 20. So some reservoirs it may work, because all you do is take it, multiply by 7 times, say, $4, it's $28. Put $28 in your lifting cost, you add $15 of lifting costs, a few dollars, so you wind up with a $50, $60 break even. In a poor quality reservoir, you can't do it. But it's really the problem with taking the CO2 out of the power plant, making it so that it has to be clean to be re-injected into the ground. And we recycle it, so but it has to be clean. And if it's not clean, it corrodes everything. And so that's really the economic issue, is making sure the CO2 is clean, and it's an expensive process.
Okay, we'll just take these last two and then call it a night, yeah? You, please, first, sir.
Yes, Dr. Chazen, thank you for joining us this evening. I'm Paresh Patel, also a member of the Emerging Leaders Program. I'm also a Oxy alum by way of my dad's work when we lived in Oxy, Libya, Tripoli, going back quite a few years. My question to you pertains to the issue of carbon emissions and what your views are on carbon pricing, how you would approach mitigating that potential risk in your business model. Thank you.
Well, we're not interested in wasting. Our CO2 business basically re-injects all the CO2. The carbon risk, is really beyond our ability to manage. We produce oil principally. We're a low gas producer, and we really can't do much about the world CO2 business. We try to be efficient as possible. We try not to produce any much pollutants as we can. But as far as somebody saying, well, we can't burn oil, and we just can't do anything about it. That's what we do. We produce that. We produce oil. I don't think that there's going to be less oil used in the world. Very difficult to go to Bangladesh and tell or China, there's 600 million Chinese that the Chinese plan to move into the cities out of the farms. Very difficult to go there and say, look, you really can't have any more energy because this is going to create more carbon in the world. And so you're not going to have lights and those sorts of things. The guy looks at you and says, look, I got nothing in this game right now. And so, I don't care about whether the United States, it floods in San Francisco. So I think there's not much we can do about Oxy as a company to do about it. We don't run a diversified business. We're not going to go into something we don't know anything about. Hard enough time doing what we know how to do. So I think it's a practical matter of we produce as efficiently as possible. Our business is basically producing oil efficiently. We can't solve a CO2 business. We don't view that as having a significant risk to our business over the next decade or so.
Sir, please.
Thank you. So it looks like there is a talent shortage for mid-career professionals in the oil and gas industry. Do you see this as an issue, and what is your strategy to manage that?
Well, certainly an issue. The only way to fix it is we have a plan that says 10 years experience in 5 years. So what we're trying to do is give people 10 years experience in 5. And that's really the only way out of it. The business hired cyclically. That is, when oil prices went down, we didn't hire. When oil prices went up, they hired a lot. And so we wind up with these demographic holes. And we're now faced with a large demographic hole. Again, the average age of our employees are 45. They're either 30 or 60. So I think that the plan is to train people so that we can give them 10 years experience in 5. It takes 10 years I think, to be fairly competent in our business.
All right. Well, ladies and gentlemen, let's give a nice round of applause to Mr. Steve Chazen. Thanks very much.